Hi everyone, my name is Onode Rojas. I really want to appreciate everyone that has subscribed to my YouTube channel, and if you know you have not done so, kindly do that by clicking on the subscription button below, so that when we release new videos, you'll be the first person or among the first persons that will receive a notification. Okay, in our previous classes or sessions, we looked at bookkeeping and accounting, where we say a bookkeeper is not an accountant, but an accountant is a bookkeeper. We said the work of a bookkeeper ends with the preparation of a trial balance and other adjustments, but that of an accountant continues till the final account and even beyond. Then also we discussed the principles and practices of double entry. We said of the golden rule: you debit the receiver and credit the giver. We say for every debit entry there must be a corresponding credit entry. That means all transactions must have two legs for it to stand. So also we discussed the subsidiary books and the source documents. About the source document, we have the statement of account, we have the credit note, the debit note, we have invoices, we have receipt and commercial invoice. So of the subsidiary books, we say we have 6 subsidiary books. We have the sales day book, the purchase day book, return inward day book, return outward day book, cash book, and general journal. And also we also consider the principal book, which is the ledger. I would say the ledger is the permanent book in which transactions are recorded permanently. It is in this ledger that the double entry principle is applied. It's not applied in the subsidiary book. Subsidiary book is just to keep record in the chronological order, but for the ledger, this is where we apply the double entry principle. So today we are going to be looking at the cash book. And the cash book, we're going to be talking about the different types of cash books we have. We have a single column cash book, we have a double column cash book, we have a 3-column cash book, and we have the petty cash book. So let's get started. The cash book. The cash book is a financial record that is used to track all cash receipts and payment in an organization. It is used to track cash receipts and payments in an organization. The cash book serves as both a subsidiary book and as a ledger. When we are treating the subsidiary book, I made mention of cash book when I said we have 6 subsidiary books. So we have the sales day book, purchase day book, return inward day book, return outward day book, the cash book, and the journal proper. So the cash book featured as a subsidiary book and also as a ledger. So transactions are recorded in the cash book in a chronological order, in the order in which they occur. The cash book helps to monitor cash flow, how you spend your money, how money comes to the organization, you spend it, you keep track of your spending. So we have different types of cash book. Like the first, we have the single column cash book. This single column cash book records only cash or bank transaction receipt and payment. It has only one column for either cash or bank. It doesn't have both cash and bank. It's either cash or bank. Maybe for instance, now a company just started and doesn't have a bank account. It only uses it spends cash. It doesn't have a bank account. So that business can only have a cash book, a single column cash book, where it will have a column for its cash. But for other businesses that we don't want to operate cash, we want to only operate a bank. In that scenario, the cash book is going to be a single column cash book, could be only for bank column. So it can either be a single cash book for cash or a single column cash book for bank account. So the next one we have the double column cash book. This includes both cash and bank transaction. It has two columns, one for cash, one for bank. The first one we said has only one column, either for cash or for bank, but the double column cash book, it has a column for cash and also for bank transaction. We also have the three column cash book. The three column cash book considers three columns, one for cash, one for bank, and one for discounts. It can either be a discount received or a discount allowed. A discount received or a discount allowed. What is a discount? What is discount received? Discount received is like, okay, let me use a layman language to explain discount received. Discount received is when you want to buy from the supplier, and the supplier said, okay. After buying from the supplier, we want to pay the supplier back. And the supplier said, okay, if you can pay me before the end of so and so period, I'll give you a discount of so and so amount. That is a discount received. But discount allowed, if you tell your debtors that if you can pay me between so and so period, I'm going to give you a discount of so and so amount. That is discount allowed. Discount received, discount is different from trade discount. The life cycle of a trade discount, like I said earlier in this series of lecture, I say it ends with the subsidiary book. It ends there. It doesn't go past there. Maybe you want to buy from your supplier, and the supplier gives you discount even before you made a payment. That one is a trade discount. It's not discount received or discount allowed. So let's continue with how you get used to those two terminologies. So the next one, we have a petty cash book. So it records small routine expenses, e.g. office, supplies, transportation. It's a petty cash book. They just keep the money and say, okay, I don't want to be doing transfer, I don't want to be doing so and so. Okay, for this amount, I just agree that I'll be keeping 20,000 with my petty cashier, so that you'll be buying all these small items for the office. When the money gets to a level, the money is being reimbursed. When we get to petty cash book, we understand it much more better. Like I said, we have types of cash book. We have the single column cash book, double column cash book, then the three column cash book, and the petty cash book. Of these three, are going to be considering single column cash book, double column cash book, three column cash book. We move the petty cash book to its own topic. That we're going to lecture petty cash book on a separate video. Okay, now let's look at the specimen of each type of cash book. The first one, we have the single column cash book. This is how it looks like. You have column for date, description, folio, amount. Like I said, which can either be a cash or bank column. We have the date again, description, and folio, amount. Then there is a line that divides it into half. We have the same thing on the debit side, which is this side. This is debit side, the arrow. Then this one is the credit side, like we knew before, C arrow. Credit and debit side, the same information, date, description, folio, amount, then date, description, folio, amount. The next time we have the double column cash book. So you have the same information, but only one thing that changes. So we have the same thing. We have the date, description, folio, cash, and bank. This is what defines this double column. Is this a cash and bank? Every other thing is the same, but cash and bank, including another column to represent cash and bank. The same thing on the credit side: date, description, folio, cash, and bank. So the next one, we have the three column cash book. Three column cash book, we have the column will increase by one again. We have date, description, folio, cash. Three column star, cash, bank, and discount allowed here. Then on the credit side, we still have date, description, folio, cash, bank, then discount receive. Look at it. Discount receive is the credit side, while discount allowed is the credit side. Why is discount allowed here? Why not discount receive here and discount allowed here? We'll get to 3-column cash book. I'm going to explain that. Okay, having known what a cash book is, so let's take an example for a single column cash book. Example, it's January 1st started business with 20,000 cash, then second paid rent cash 2,000, third bought goods for 7,000 cash, then we have January 10 sold goods worth 2,000 cash, then January 20 paid salary 700 cash, then January 31st says sold goods worth 10,000 cash. Say required prepare a cash book. Just looking at this example, you know that it's a single column cash book because all the transactions are all cash. There's nothing, no mention of cash and bank, no mention of bank. So if it were to be all bank, it will have been a single column cash book but with a bank column. But this one is a single column cash book with a cash column. So let's solve this. Okay, now let's solve the question. So let's prepare the cash book first because we are asked to prepare the cash book. This is a cash book. We have dates, particular, which can also be called description, then folio, amount, date, description, describing what the transaction, then folio, amount. Let's quickly solve this question. So required, prepare the cash book. Let's prepare cash book. This is a single column cash book, date, particular, folio, amount, naira sign. Make sure you enter the naira sign. Date, description, which description can also be called particular, then folio, and amount. So let's start with the first transaction. It says on the 1st of January started business with 20,000 naira cash. Starting business 20,000 naira. So the money used to start a business is called capital. So capital represents the owner of the company, while cash represents the company itself. Because of this entity concept, which says that the company is an artificial person, that the company is different from the owner of the business. So the capital that an individual used to start the business will be seen. Let me just use the word loan to the company. The company doesn't have money. It is the individual that owns the company that gave the company take 20,000 to do business. So capital, if you are to go to the ledger, you are supposed to have a capital account and a cash account for the double entry purpose. But here we are only asked to prepare the cash book. So we are only going to be considering only one leg of each transaction. The double entry principle says debit the receiver and credit the giver. So the owner of the company is giving the business 20,000 naira, so, and the business is receiving 50,000 naira from the owner of the company. So we are going to be debiting the cash book with 20,000 naira because the company is receiving 20,000 naira from the owner of the company. So on the January 1st, we go to the debit side. We say first, which is a capital. So I go to capital account, I'm going to see 20,000 naira with the narration cash on the credit side of the capital account. So the next one says paid rent cash 2,000 naira. Now the company is paying rent. That means money is leaving the company, and we said anybody that is giving out, credit the person. Anybody that is receiving, debit the person. In this regard, the company is giving out, so I go to credit the company with 2,000 naira for rent on the second. 2 of 1 narration rent. So I go to rent account, I'm going to see this transaction debit side rent account 2,000. The next transaction is bought goods for 7,000 naira. Now the company is buying goods. If they are buying goods, they receive the goods, but they have to pay for the goods. They pay 7,000 and left the cash because it's January 2nd, January 3rd of January. What will be purchased, which is bought purchase account. If you go to purchase account, go to see this transaction on the side of the purchase account. See this appear on the credit side of the cash book. Next one said sold goods worth 2,000 naira. The company gave out goods, but they received cash in return. So they receive cash. Cash is coming to the business. So you are going to debit cash because that is what the voluntary principle said. It said if you debit the receiver and credit the giver. So now we are receiving cash into the company. So 10th of January, on the debit side, 10th of January, narration, sales, or you can also call it revenue. How much was it? 2,000. So the next one says fixed salary 700 naira, and the company is paying salary, money is leaving the company, it's leaving the company's pocket. So it's going to the credit side. January 20th, no, this one is a 3rd of 1, January 30th, 20th of 1. Narration salary. For salary account, I'm going to see this transaction on the debit side of salary account 700. So next one is 31st, sold goods worth 10,000 naira cash. You are selling goods, like we said before, you are selling goods. Goods is leaving the company, but cash is coming in. So cash is coming into the cash book. Cash book receiving it on the 31st. On the 31st of 1. Narration also sales, so called revenue. How much? 10,000. So I think that is all we have there. That is all we have there. So now it's time for us to balance the account. Before we balance the account, let me explain something like I've been explaining why we were solving this question. Like kind of have rent on the credit side of the cash book. I said if you go to rent account, you're going to see, if you have to open a rent account also, if you go to rent account, you're going to see 2,000 on the debit side of rent account with the narration cash. Likewise, purchase. If you go to purchase account, you will see 7,000 on the debit side of the purchase account with narration cash, which completes the voluntary principle. Likewise, the sales account. If you go to sales account, you're going to see 10,000 on the credit side of the sales account, not the debit side. You cannot have two debit transactions for one transaction. As in, if you have a transaction saying sold goods for cash 10,000 naira, you go to sales account, you see it on the debit side, come to cash account, see on the debit side, and you see you have not obeyed the voluntary principle. One will be on the debit side, one will be on the credited side. That's why sometimes when you make mistake, instead of you debiting an account and went and credit another account, they came back again and debit the wrong account. Your trial balance will still balance. So we'll get to the errors that will not affect trial balance. We are going to discuss that we have different types of error, error of commission, error of principle, and others. We'll get there, we'll discuss that. But for now, just stick to what I just told you. So now let's balance this account. How do we balance the account? Add up the debit side and the credit side. Add up the debit side. Let's add up the debit side. We have this will give us as 2,000. Like this somewhere else. Then this side will give you 2 plus 7 plus 7 will give you 9,700. If you look at it now, which one is greater? 97 and 32. 30,000 is greater. So just come here and enter 30,000 that is greater. Repeat the same thing here. 30,000. Yeah, that is all. Then if you look at it, if you add up here, it gives 30,000, but if you add up the credit side, it's not giving me 32,000 naira. So what is the difference that made me not to get the 32,000 naira? So if you add this one, which you had 97 before, 32,000 minus 9,700, you have 22,300. So we come here and put the balance here, 22,300. This will then serve as what our balance carried down. This is the balance carried down. If you come this way and type here, balance brought down, balance brought forward, 22,300. That is telling you that we still have total value of 22,300 naira cash with us. This is what we have at hand. We started with 20,000 naira, but now we are having 22,300 naira cash. And from here you can see that the cash book has a debit balance of 22,300. That is all we are required to prepare here. Okay, that is all we can take for today. In our next session, we are going to continue with the cash book. We are going to be considering both the double column cash book and the 3 column cash book. Bye for now.